As always, the information contained in this presentation should not be construed as a recommendation or an offer to buy or sell any security or financial instrument. Additionally, information contained within this presentation does not imply the suitability of any investment strategy. We are not licensed brokers or investment advisors. All attendees of the presentation and purchasers of our content are encouraged to speak with a licensed representative of their choice regarding the appropriateness of investing, trading of any investment, or any trading strategy. We are using real-time market data and will be executing trades in a simulated account during our presentations. No offer on our part respect to the sale or purchase of any security is intended or implied. The intent of this information is for instructional and educational purposes only. Any fair use of third-party trademarks or logos does not imply an affiliation or a sponsorship. All trading involves high risk, and past performance is not indicative of future results. We make no promises, guarantees, warranties, suggestion that any information shared will result in a profit and not in a loss. And you agree to not hold us legally or financially responsible for any reason. Okay, so let's jump right in here. What is a pre-market routine? The definition that I use for a pre-market routine is that this is an information gathering process. This information gathering process is designed to help me understand the trading environment, not to create a bias or make a decision based off of a single data point, but to evaluate several points and things that are inside the price charts, but mostly the things that are outside the price charts. Yeah, for most products, like if you're a options trader, trading stock options, okay, the underlying stock controls what the option does and going up and down. Okay, that's where you have your Black-Scholes model, you have your all the Greeks that go along with that. In the futures market, also a derivative market, the underlying physical market for the future controls what the futures are doing. Therefore, the stocks that make up the index have a greater impact on how that futures product moves, or the physical market like crude oil or gold or something like that. The actual physical market moves up or down, and then we see that the Globex computer adjusts the price on the futures. Okay, so those are some things like the physical market that's outside of the price chart when you're just looking at a futures price chart. So we want to be able to separate how we make a trade versus information outside the price chart. Okay, know the difference and really make that conscious contact to separate the two. When you're doing a pre-market routine and gathering information, it's very easy to get sucked down a rabbit trail and trying to find your way into a trade. Our desire to make a trade is often much more stronger than the desire to gather the information. Okay, but just as we are crossing a street, okay, you've got to look both ways. You've got to gather information to see if it is safe to engage in the crosswalk. Often you're looking at a sign across the street saying walk or don't walk. You're looking at traffic lights. You're looking at how big the road is, whether the traffic is loud or quiet. There's so many pieces of information that you gather in an instant to decide if this is a safe environment to cross the street or if you need to wait on the side for a little bit longer. The same thing in the trading the markets, okay, is that we need to know what to look at outside of the price chart. Now, of course, that information doesn't make a trade, but it helps you understand that trading environment. Really, it's no different than, hey, you're getting ready to go out and run some errands, and you kind of look out the window to see if it's hot, cold, rainy, foggy, sunshine, and then you make an assessment on what you're going to wear. Okay. Now, when you look into the market, what are some of those specific things that we can use to help gauge maybe the market frequency, the tempo, the pace that the market may be moving in, whether it's a fast market or a slow market? And that's what we're going to dig into uh, here. So we're preparing our head in the game. The pre-market information does not negate from technical analysis, trade plans, whether you're going long or short for trend analysis and stuff, or pattern recognition. Sometimes you see the continuation patterns or you see reversal patterns and things like that. Those are all still part of information gathering. But the things with technical analysis, as you're looking at technical analysis, trade plan, pattern recognition, and then you get to your setups, entries, exits, and profit targets, that's the application phase. Okay. As you start gathering that information, okay, to apply a trade. And once you apply a trade, then you have a specific place to enter, just as we did on the prior chart right here. Okay. We gathered information. This is a technical analysis pattern that I find where I have resistance, the area below resistance being my buy territory. Once price takes out the sellers, okay, you can have a trade, taking the breakout trade, okay, and the breakout trade must be there before you have a supply and demand trade, okay? As price came back down into this area, we found an area where we had the potential of an imbalance of orders. We use a leg-based group of candles, okay, to help us identify that. And then we had price come back down to the origin of the move out that took out all the sellers. And then we look for that buying opportunity, okay? Now, there are some more subtle details, and we're not getting into the technical analysis part of this. We're getting into the information gathering part. As I talked about earlier, just to give you a little heads up, the leg-based group of candles where I identified my risk or entry, stop loss, the risk on the trade, okay? Um, the leg candle leaving was smaller, okay? That tells me the zone can only be used one time. It's a proximal line entry. Okay. Sometimes you can get big moves out of it. Very often you can get a 1-to-1. Okay. But now it prices deeper in the zone. Okay. We know the zone can only be used one time. So now we're not looking to take the trade again as it's deeper in the zone. Okay. So some other details. And those are in some of our other recorded showcases where we can demonstrate that for you. So as we are preparing each morning to get our head in the game, okay, we need to understand that this is something that's continuous that we must do when having a trade plan. It's not something you do once a week, twice a week, okay? You do it every single day. You sit down and start to approach the market. Just like every single intersection that you get to that you're engaging in a crosswalk, you take a couple of seconds to evaluate all the conditions around and all the information to see if it is safe in order for you to cross and engage in the crosswalk. So, in all of this information gathering, it is important that you have a way that fits your trading style to verify and document the chart patterns along with fundamental information. And that fundamental information is those things outside of the price chart. Now, this does take a little time. If you try to do all of the things I'm mentioning at one time, you're going to get overwhelmed and you'll kind of push it off to the side. Don't start there. Just start with one or two pieces of information and track it. I'm going to give you several pieces. Some of you are familiar with many of these already because they're part of my pre-market tips every day. Look for this, look for that, and so on. Okay. So start off with one or two things as you verify and document. It'll take you about 20 or 30 times of verifying and documenting that information. And then miraculously, it just feels like, hey, it becomes part of your routine. No different than looking left and right before you get ready to engage in a crosswalk. Okay. Now, back testing versus forward testing. Okay. Make sure when you're back testing chart patterns and this type of information is that you compare apples to apples and oranges to oranges, so to speak. Okay. This may mean that you need to go to a little larger time frame or a smaller time frame and go back and verify information of when announcements came out or economic announcements, when contract rollover happens, and so on. Okay. Keeping a journal of key takeaways as seen in the Mastering the Charts recap and review each day or each week. Okay. Now, in our Discord room, okay, there we go. Okay, in our Discord room, we do post our Mastering the Charts recap and review. Okay. Now, what I'm making reference to is that you can go and take a quick look at how we use that information. Okay, we start off with our daily overview, news, economic reports, things that are happening in the pre-market that we're looking for to help understand the trading environment. Okay. Now, as we go through, we kind of document some of the trades that we've taken. Then our team, the admin, okay, takes in and says, okay, this is what I summarized from your pre-market tips. Equity indexes, S&P, NASDAQ, Dow, Russell, starting inside day with an upside breakaway gap, okay? No trade, no breakout trades, so because this is one of the things we're going to be talking about. You say, hey, we're not taking any breakout trades when we're in an inside day, okay? If price opens within the prior session's range, we look for some other information, which I'll share in just a few moments. But this is a great example of putting together a journal of what's going on in the pre-market, okay? And then after market opens, you continue to verify in your journal the different pieces of information. So thank you again, team. You guys do a great, great job of putting this information together each week for our Mastering the Charts recap and review session. And as you get more and more into this, you start seeing the trade opportunities, the setups, but understanding that information outside the price chart and what to look for is of great, great importance. Okay. So some elements of the pre-market routine. So as we break this down, we're going to identify the task that we're going to look at. What are we looking to document? Okay. Then we're going to verify some of our information sources. Now, start off with the sources that you're comfortable with. Okay. And then change them up from time to time to verify the reliability of that source of information. Often around the holidays, we get different people we get people that are posting information on information sources like websites and information that we gather. You can tell when one person is on vacation and another person has taken over the slot for the first time or so. Okay, the information is not quite the same. Okay, so you may have two or three different resources that you can go to see, are all three resources saying the same thing or two of them different than the other one? And these are little heads up or these are little heads up information that something that's not quite right. So the moment you feel it's not right, go and verify the information on your additional resources. Then we have some comments. What is your analysis on the task and from the information source? Okay. Is it positive or negative news? Are the markets correlated? Okay. Now that's a key point right there. Are the markets correlated? Do you recognize for your trading plan what market conditions are more favorable, giving you the desired outcome? Okay. Or which market conditions are like, "Ugh, yuck, I don't like this." Okay. Are you fully aware of that? If you're not, then that desire to make a trade is going to overwhelm you. You're going to start clicking the button. And then, of course, you get into that panic mode. Okay. And you start fighting with the market. We want to have easy price movement and we want to have high probability, low risk trades. Therefore, we need to understand what's going on outside the price chart as well as on the price chart to help us with that and help us to gauge risk. Okay. Then we have another component, which is the output, things that we track, document, like our key takeaways, and then document this in the journal. Save the picture of the price chart during the news announcement for your trades. Okay. Now, the act of doing all of these things gives you a flow of uh, almost like a checklist. Now, doing this several times, you become very familiar with how to, and it becomes easier over time. Okay. So we're going to start off just with some highlights of our basic pre-market routine. And this is what happens when I sit down and start gathering information about the trading day to help new students and students that are old students as well, uh, help understand the trading environment as they are learning to assemble their own pre-market routine. And let me preface this one more time. This is not an end-all pre-market routine. These are pieces of information that I collect over the years and I've documented and verified, and I found them useful. When I was told, and I started working in a prop firm and way back in the day, and going into these rooms, everybody was crazy, just crazy market conditions there. This is back in 2000. Woof, 25 years ago. Woof. Now we're dating ourselves. Um, Having a set way to look and gather the information, starting off with one or two pieces, verifying it, okay, documenting this so that anytime that this specific condition comes up, you need to either speed up or slow down. Okay. So I'm going to step into this. First thing we're going to look at is the news. Okay. So everybody looks at the news. We see the headlines. What's going on in the market? So what do we do about that? Well, we got our task. News can shift the market sentiments and move the markets. But note, banks and institutions receive that news in advance. There's too much risk in the market if they don't. Okay. Now, the SEC deems that releasing the news when it's available, especially economic reports and things like that, is not fair to everybody. So they designate a time that they can release the news. So the more you dig into this, you realize that all news is placed in an embargoed area and the timing of that release, okay, the timing of that release is usually noted on a schedule when they're going to release that news, okay? So all news is breaking news stories is approximately 45 minutes to an hour old information. Now, the people that pay very big prices can get the news earlier than the marketplace. Okay. Having a Bloomberg terminal where you got news sources from hundreds of different places lining out, okay? Different news and things like that. It does take a moment to verify the news, but if you think about the dissemination of news, well, the event had to happen. Somebody had to get a selfie in it and document it. That documentation had to be edited, and from the editing, then it had to go into a place for the news to review it, verify it, and then by the time it becomes breaking news story, it's already about 45 minutes old. Okay. Now, if we're anticipating a breaking news story and they give us a time of an announcement, we can identify price behavior about 45 minutes to an hour before that breaking news is announced. We can start to see that somebody has that information. So just the task, read the news. A couple of information sources that I use for myself, okay, to verify. I got 3 sources, MarketWatch, we got finance at yahoo.com, Forex Factory. There's hundreds of these out there. You find the ones that fit your style, your way of looking at things, okay? Now, as far as the comments, when it comes to news, is the news positive or negative? How does it make you feel? Optimistic, pessimistic, good news sometimes can be bad for the market, and bad news can sometimes be good for the market. So what we do as far as the output on this is we divide the paper into 2 columns. One's labeled positive news, one's labeled negative news. So, one there, we grab MarketWatch. So in grabbing MarketWatch right now, okay, I'm just going to go out and look at the headlines, kind of give you an example. As stocks wobble, these 2 rarely noticed measures say valuations are stretched. Now, you don't need to dig into that article unless you want to know a little bit more, but the public doesn't dig into the articles, okay? How does this make you feel? Does this article right here, the headlines, make you feel bullish or bearish? Make you feel like you want to rush into the market and buy everything up? Or does it say, hey, you know what? I should dig in and think about this a little bit more, okay? As you look at headlines, everything that is in bold print, okay, is what the novice traders are looking at. Now, the reason that the reason that these articles are in big bold print and they're at the top is because of people clicking on them. That's how they make money with all these different advertisings and things going on. Once you click on it, you get a whole second set of advertisements, okay? So the reason that these headlines are at the top is because of all the novice and traders are clicking on these and they are forming opinions about the market. Now, this is why I say don't dig into the article, just read the headlines. Does it feel bullish or bearish? Okay, and as that outcome, we just divide the paper into 2 columns. One is negative news and one is positive news. Now, the news itself does not make a trade. Let me be very clear on that. Okay. It doesn't tell me where to get in. It doesn't tell me what the risk on the trade is. And it doesn't tell me what my profit potential is. It's just news. But the reaction and identifying, is the news positive or negative? How does it make you feel? Will give you a sense of whether the market is feeling bullish, more check marks on the bullish side, or if the market is feeling more bearish. And some days you kind of get equal number of hash marks on both sides of your column, okay? So what's in the news? Well, UBS leapfrogs, UBS with new S&P 500 price target. 22 dead from Memorial Weekend storms devastating several Kansas City. Hey, sometimes you're going to get into whether the news has nothing to do with stocks or market conditions, okay? It has to deal with other things. Well, what does that tell you? Okay. And it says, well, if they're not talking about anything else in the news, then that's stock related or futures or related to trading, then there's not a whole lot going on. Okay. Economic reports. Okay. The task. The economic reports calendar refer to the scheduled dates of significant release or events that affect movement of individual securities or prices in the market. Okay. Now, what are we going to do with that? Well, we got economic reports coming out pretty much every day. We have some economic reports. Okay. What is your information sources? Okay. So what are we going to do with these economic reports? View the economic reports for today and then just glance forward 7 to 10 days and see what reports are coming out. Some economic reports have a multi-day impact on the report. Okay. Now, what we're going to be watching for, and one piece of comment or piece of information that we have documented in the past, with this new administration, the market conditions have changed slightly, so we're restudying the same things to see if they still have the same impact. Okay. For example, we used to notice that starting 5 days before an FOMC announcement, the market would typically go up about 3.5%, 4%, starting 5 days before the announcement. After the announcement, it would go back down that 3.5%, 4%. Okay. Now we tracked this every 6 weeks when the FOMC announcement came out for many years, and we found it to hold true under a different administration. Okay. Now things are changing, and we have to restudy and verify that information to see if it still holds true. Okay. So by studying these economic reports and understanding what happens before the report and what happens after, okay, we can see that some upcoming news events have a multi-day impact. They grade up, so grade upcoming news items, anticipate their impact, like GDP numbers coming out, or other economic reports coming out. We have to be prepared for that market reaction. Okay. Let's see. So the output for this is basically track the economic reports and their impact on the pre-market and market action to get a feel for what's normal markets. Okay. And what's an extreme move. Other events that coincide with economic announcements also play a part. Okay. And we need to be watching that, especially if a political crisis, war, etc., comes out the same time an economic report does. We have to kind of weigh that in. Was it the news or the economic report that caused the reaction? Okay. Now, what we have noticed in the last 8 weeks, 9 weeks, is that when the economic reports come out, we often see that prices get some volatility. Many traders are conditioned to wait till after the report in order to initiate a trade because they don't know what the volatility is going to do. Okay. What we have noticed over the last 8, 9 weeks here is that when we have groups of economic reports coming out at the same time, 2 or 3 economic reports coming out at the same time, it's been a non-event, meaning the market didn't react crazy like it did in the past. These are some of the changes that we're noticing now. When we have single economic reports all by themselves, like the 10 a.m. consumer confidence in this example, there's only one report coming out at 10 a.m. We often see a bigger reaction. And this has just been happening the last 8, 9 weeks. These are things that we observe so that we're not building up and putting a lot of pressure on ourselves to try to jump in a trade, especially when we know that 2 to 3 economic reports coming out at the same time has little effect on the way the price jumps up or down. Okay. But when there are single reports, we have seen a bigger reaction in price. Okay. Now, some of these economic reports, you can measure the reaction to start to get an idea where the unfilled or the hedges are ahead of a report. Many traders back away and wait for the report to come out. The reaction if price jumps up is there's a lack of sellers and price shoots up to find the sellers. Not that everybody's buying, okay? Or if something comes out and the market drops really quick, it's because everybody's on the sidelines, and it's not because everybody's selling. It's the algorithms trying to make the market. And the market price is going to drop to find buy orders. It's going to shoot up to find sell orders in order to make a market. The reaction exposes where the hedges and the unfilled buy or sell orders are at. And this is this is what we have to bring into our way of looking at the market. The reaction is price, the algorithms adjusting price up or down to keep our market liquid. Okay. Another example of this, pre-market indicator. So we look at the pre-market indicator, okay? You can go to NASDAQ.com, you get the extended trading, the PMI on TradeStation and on TradingView. The ticker is QMI, okay? The pre-market indicator. The NASDAQ 100 pre-market indicator reflects trading activity based on pre-market opening prices for the NASDAQ 100. It gives an indication of the pre-market opening price for the index each trading day. The NASDAQ exchange developed the indicator to give investors and traders better view of market activity prior to the official 9:30 a.m. Eastern time, based on actual price and volume data for the NASDAQ 100 stocks. Also note that the pre-market indicator has a 92% correlation as to traders' sentiment at the open. So each morning we are looking at the pre-market indicator, as is the NASDAQ exchange, to help, they're the ones that created this, okay, to help them gauge and offset their risk, okay? Are the traders' sentiment bullish or bearish based on the number of upticks and up volume and downticks and down volume on the NASDAQ 100 stocks trading in the pre-market? So the output of this is the pre-market indicator positive, neutral, or negative? Track the PMI daily to gain confidence in its correlation to the market open. Now, we could have a pre-market indicator gapping up, okay, but the futures are actually dropping. This would give us an indication that futures follow the stocks, so that drop into the demand zone could be a good trading opportunity to go long and watch how futures and cash balance out, okay? So a good look at this is you're going to document the change and percentage change within 10 to 20 sessions, and you will have a good feel of how the pre-market is setting up for the open. What we're looking at this for is to see if there's a bullish sentiment or a bearish sentiment. We're also looking to see, based on the percentage up or down, or the number of points up or down, what is a normal range, what's extreme, and what's almost like a non-event. Okay. You become aware of how the trader's sentiment is at the open. And then we look for the opportunity to execute on a trade during that time. This is a big one for me, and it's something that I gather each morning, called inside day versus outside day. With the inside outside day, basically an inside day is where price in the overnight session has traded inside the prior session and has not broke above or below. Okay. Now, inside days tell me that, hey, market conditions can be a little choppy. I don't trade well unless I'm just scalping the market on inside days. So that trading environment with an inside day, okay, we don't get breakout trades that work. They often fail. So waiting for a demand zone or supply zone becomes a higher probability outcome as far as the trade. We also notice and document over and over again that on an inside day, often trading the open can be a lot more tricky. Waiting until after 10:30, 11 a.m. Eastern, the market has settled out. Now, if we're an outside day or price has broken outside the prior session's range, we can be a little more aggressive. There's more trending market potential. Okay. There's more, we can take breakout trades, we can take zone entries, and we look for that volatility to be a little bit more aggressive when price is broken outside the prior day's trading range. Okay. So in the pre-market, and what I do here is I've always marked the prior session's high and the prior session's low. Okay. When price is inside that range and has not broken, that tells me that I can back away. I don't have to be aggressive to look for a trade. It allows me to calm down. Okay. So by identifying that, and then at session open, was price gapping outside the prior day's trading range, or was it back inside? Now, that other elements about that is if price opens inside the prior day's trading range, often we see price return to the 5 p.m. close area or the gap fill. Okay. And this happens, I would say, probably about 7 out of 10 times we will get the gap fill if we open inside the prior day's trading range. Probably a little better than 7 out of 10. Okay. If price is broken outside of the range and then opens inside, you're still about that 7 out of 10. You're going to fill the gap. Price opening outside the prior session's high or low, often the gap doesn't fill the same trading session. Probably about 8 out of 10 times it doesn't fill, it just continues to move in the direction of the gap. Okay. So inside days and outside days, they do help me gauge the market condition very quickly so that I can dig deeper and find more information, or I can back away and say, okay, slow down. There's nothing to do right now. Okay. Monitoring things outside the price chart. We got the trend, the tick, the VIX, and the advancing issues over the declining issues. Now, I use this more like like a dashboard in my car. Okay. You got temperature lights, you got tachometer, you got oil pressure, you got gas, you know, that's all we're looking at. Now, looking at the dashboard does not help you drive your car, but it does help you understand the conditions of how your car is running. Okay. The trend, the tick, and the VIX and advancing issues over declining issues in this example, okay, are all related to the NYSE, New York Stock Exchange. There are some other ones like the trend Q, the tick Q, and the ADD with the letter Q behind it, okay, that pertain to the NASDAQ exchange, okay? So a little more explanation on the inside day, outside day. Since I've already explained it, I'm just going to briefly go over it. During the pre-market, it is important to note if the indexes are inside the prior session, have not broken, inside days where price is still within the prior session's high and low, these can be conditions where there's more choppy uncertainty in the marketplace. We'll be range bound for a little bit until price finds demand or finds supply. So information source is use a daily chart or smaller chart, mark the prior session's high and low. Okay. Is it an inside day or has price already broken it? An outside day. An inside day is designed to take your money. Okay, and becoming aware of inside versus outside days can help you gauge the tempo and if this is the best trading environment for your style of trading. So what we're doing here is mark the high and low of the previous trading session and just look, is price inside and not broken, or is it outside and has broken? Now gaps fill more often on inside days, up to about 85% of the time, whereas outside day, the gap fills about 70% of the time, and they take longer to fill, okay? If price does not fill the gap the same trading day, okay, it doesn't fill it by the next session open, it may take approximately 7 to 10 days on average for that price to get back to this area for the gap fill, okay? Verify and become aware of this. Expectations as to volatility at session open. Verify waiting till later in the session, especially if we're an inside day, just say, okay, I'm not going to trade till after 10:30 Eastern or the first hour of trading, okay? And if I do take a trade, it'll be a zone entry, not a breakout trade. Focus on smaller profits while price is still range bound inside the prior day's trading range at 1-to-1, and possibly a few times you'll get 2-to-1 profit, okay? Just manage expectations that you're going to look for a small move. Another example here, and you can see I'm stacking a lot of things that I do intuitively every time that I look at the markets. Okay, get up every morning, start doing this pre-market routine. I want to know, because futures follow cash, are futures trading at a premium or futures trading at a discount? Okay. This is where we're going to use the Dow 30 pre-market volume. Okay. So as we track the pre-market volume on the Dow 30, okay, in the pre-market, if we notice that the volume is very light in the pre-market on the Dow 30, okay, we can anticipate that whipsaw price action or more volatility will come into play as the algorithms kick in around session open. We might get some big jerky price moves, okay? Low volume invites high volatility, okay? So being aware of that, I can say, you know, am I prepared for the high volatility? What if I don't have a stop on in time? Could I lose more than I'm willing to lose? Okay. Light volume often leads to big price reaction around the morning economic reports as well. Okay. So what we do with this information is we monitor the Dow 30 stocks. Okay, here we go right now, Dow 30 stocks. Okay. For this, I'll just explain this. It's in great detail in the course material. Is we take the number of Dow stocks that are greater than 94 cents negative and greater than 94 cents positive, and we net the results. I have 3 positive and we have 17 negative. The net results would be 14 negative. If I take 14 negative and multiply it by 2, I get a value of 28. Now that tells me that cash equals negative 28. Right now, I see S&P futures are trading at negative 19. S&P futures are below the cash. Sorry, they're above the cash value. S&P futures are overbought relative to cash. Cash is king. Okay. Now, just as a little additional piece of information is the Dow Jones 30, the industrial average, is a price weighted index, where the S&P, NASDAQ, and Russell are market capitalization weighted index. And this is why when we're trading the NASDAQ is I have the top largest market cap weighted stocks. Okay. If all the stocks are going in the same direction, then the future is going the same direction. Okay. If 4 of them are negative and 4 of them are positive, then we're getting into that choppy mess. Okay. By tracking the pre-market volume, you will start to understand what the market conditions might be around session open and any economic reports prior to the session open. Okay. If we have very light volume and there's a economic report coming out an hour before the market opens, we should anticipate more whipsaw price action, okay, on the report. The internals are used like your dashboard in your car. They don't drive your car, they just tell you how the car is running. Exchange traded funds, S&P futures, follow the stock exchange. Okay, these are internals. These internals reflect the underlying stocks are doing and act as a lead indicator on how the ETFs, exchange traded funds, will impact how the futures or options will move. Okay, so the task, well, we're going to check the internals. Information, yeah, we're going to look at the trend, the tick, the VIX, and advancing issues over declining issues. The trend high is time to buy, trend low, time to go. The tick verifies the strength. If there's more upticks, then we assume that price is being bought up. Okay, more downticks, prices are being sold. Okay, VIX high implies fear, prices dropping. VIX high, we're looking for a buying opportunity in a demand zone. VIX high, time to buy. VIX low, time to go. Taking measurements of that VIX in the pre-market can alert us to whether there is a bearish or bullish sentiment around the VIX, okay, which is the S&P Volatility Index, and break it down and find out what exactly each one of these things measure so that you know what's going on behind the scene. Advancing issues over declining issues, basically more stocks, trend direction is up on entries, pull back into demand. More down stocks, trend into direction is down entries, pullbacks into supply. If it's in the middle, there's no trade zone. Okay. So when we're looking at the advancing issues over declining issues, when we get to extremes, these are oscillators. Okay, the trend is an oscillator, the tick is an oscillator, and the advancing issues over declining issues oscillate. They stay within a range. Okay. So knowing the high points and low points, what's really going on, whether they're selling or buying, more upticks or more downticks, okay, we can anticipate at the extremes that we're looking for potential change. The extremes, until you say, hey, go look for supply zones, or hey, go look for demand zones for your trade entry. Well, that's it. Just as a simple showcase of what we are looking at in our pre-market routine, information gathering before we go and place trades. Very important to understand your trading environment and see if it's the right trading environment for you. If you have any questions, reach out. You can either do the admin, just replace my name, admin@themarketinstitution.com, or to me personally, and I can help you with some of your questions. Thank you for your time today, and enjoy the rest of the weekend and the rest of the trading day. Happy Friday, everybody. Thank you again. Bye now.